Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. Today on the EIA show, we're going to go through the overview, and then a deep dive into refined products, and then going abroad, looking at U.S. exports and what's happening in the rest of the world. Now, when we go through the beginning part, we like to give a little bit of a summary. There were a little bit of a crude draw. But if you remember last week, we were saying that we expected to see some draws, but it was just going to be the pace was going to slow down, and that's exactly what we saw. And we continue to see that pressure, especially when we look at where are exports right now, where are imports, and then that underlying demand, which continues to diminish. One of the things that we did have, gasoline demand was a little bit higher than we were expecting. We thought it was going to be about 9.3, came in at about 9.4. But when you look at Gas Buddy, Descartes, and some of the underlying data sets, there's going to be more pressure to the downside, as we saw diesel and jet fuel normalize in the way that we were expecting. So overall, we did get a distillate build, which is normal for this time of year, so nothing crazy there. And then we saw gasoline had another draw, but imports were a little bit higher than our expectations, and just based on some of the coming data, that'll still stay relatively elevated into the end of the summer driving season, which is going to kind of mute some of those draws, which we were expecting some slower draws, but that's going to be, I think, a bigger overhang. And then when we look at some of the spread of COVID in the U.S., again, nothing that's going to require any kind of aggressive government action, but it's just the consumer is inherently starting to change pace. We're starting to see concerts and some outdoor activities get canceled, and these are things that are just going to, again, just kind of cap some of that near-term demand as we head into the end of 2021. So just kicking it off here, we're just going to look at U.S. crude oil inventory. So you can see how we were essentially following 2019 almost exactly. A little bit of an increase, starting to come back down. And the one thing that, when we look over the last 5 years specifically, because you can see how there's been that big shift up, and just so you know, the catalyst was the OPEC market share fight back in 2014. But when you look at some of these shifts, you can see that there's typically some periods where you get an increase in imports, and you get an increase in storage, and then you start to see some of the slowdown in terms of where this capacity is going to come down. So again, this is something that is fairly normal for this time of year. But again, if you look at the bullish argument, or the expectations, when you look at this blue line here, everyone kind of had this linear line going straight down to go back below where we were in 2018. And one of the things that we've been saying was that that's just not how it happens, especially when you factor in seasonality. And we're always very sensitive to what's happening in seasonality. We're seeing the airlines slow down along seasonal norms, nothing crazy, but we never got back to where we were in 2019. It's just we're at this, as we've been saying, constantly at this point, that we're just going to be below what we were and what that average is, and that's going to carry through, at least the end of the summer, but very well into the end of 2021. So then when we look at days of supply for crude, you can see that we had a small shift up. We're at 27.5 days, essentially right back to where we were, just above 2017. So you can see 2017 was higher, 2016, and obviously 2020. So this is, again, this kind of normalizing where we've expected this just to go sideways. And when you think about days of supply, you have to consider what are refinery run rates doing and what is in storage. And those two pieces work with each other. And one of the things that we've been saying is that we were just going to go sideways because we were going to have refinery run rates, flatline, maybe get to 92%. They came in at about 91.8. But at the same time, we were going to see a draw slow. So as you start to see that normalized, again, that's going to be kind of that movement sideways that we're expecting to continue. Then when we pair everything together, looking at oil and then products, but more specifically looking at gasoline, distillate, residual, and jet fuel, you can see, again, just kind of this steady move down. because when we look at oil becomes products. And that's why we want to look at them together to see, okay, well, where do we sit right now? And you can see that we're still following 2019 fairly closely, but the pace is starting to flatline. And that's what we're going to want to look at, because distillate had some surprising imports. We were expecting that to come down a bit. And then when we project forward, we always like to look at, what's coming and where are things gonna shift. And there's going to be a fairly sizable move from the Middle East and Asia back into the Atlantic Basin. When you look at, specifically the Middle East, we're coming to the end of cooling demand. You're starting to see that adjust a bit. We're already seeing those increases in floating storage just because there's that shift in the OPEC deal. Then that now the Biden administration has requested them to increase more of their production. Again, there's a mixed bag within that, but we'll talk about that in a minute. But here's where we can see things are starting to level off, and it's going to be difficult to see this big continuous drawdown as we head into our normal seasonal slowdown period, which is why we call it the shoulder months. So when we look at gasoline, you can see gasoline has, as we were saying, it was going to continue to draw, but again, just at a slower pace. That started to moderate a bit. But when you look at just the general activity, we typically have this drawdown that then caps at the end of the beginning of September. And then we start to see those builds as we get this pivot from driving and into more of that heating oil distillate demand cycle. So this is something very similar. We're coming back to the lows that we've been at in 2021. But one of the things that we continue to see, especially when we look at some of these imports, that you're going to see that pace slow down. So we're still going to see draws. It just won't be at the same level that I think most or some are expecting. So then when we look at distillate, still moderate builds, nothing crazy. When you look at just the general trend, we typically have builds this time of year. One of the things that we expect is to see this accelerate a bit, especially as refiners try to manage some of their not only feedstock, but also what their storage is going to look like heading into the end of summer. Then when we look at jet fuel, one of the things that we continue to see is you can take kerosene and you can blend it into the distillate pool, and that's what they're continuing to do, trying to manage some of the storage level, because you can always pull it back out and increase some of this jet fuel. But we're seeing some of this bigger slowdown on the jet fuel side, from departures to TSA. Again, all of this is along seasonal norms. It's just at a reduced level from 2019. So we never got back to normal, and now we're starting to curtail as we go into, again, this September. Kids go back to school, people don't travel as much, and we just don't have the same type of business travel, especially when we consider what we look at in terms of international. So then when we look at just the curve, you can see the front month have shifted down, and you've gotten a little bit of a softness, essentially into 2023. But when you start getting into the belly of it and then into the out months, again, there hasn't been all that much change. So all that fluctuation is really coming in the front end of the curve, with more than enough room to layer on some puts if you need to. There's the costs have come down just given where some of the shifts are, especially when you start looking down into the end of the remainder of 2025, which again is not predictive. It's just a matter of how are you going to sanction projects, what kind of projects are you going to sanction. And that's where we continue to see some of this longer term investment that's going to continue to happen within the Middle East and in Libya for one, which in Libya just had to cut some of their exports, but we'll talk about that in segment 3. Looking at COVID, because who doesn't like to talk about COVID at this point? When you look at the U.S., the U.S. has had an increase as the Delta variant continues to move through. Again, there's still, we're getting, elevated levels of hospitalizations, but still nothing that is going to be detrimental to infrastructure and any of those kind of fears. But one of the things that we're looking at is the UK, where you can see that the UK peaked, came back down, but now is very slow in moving lower. And now we have fun headlines about Lambda, because why not just continue to use the Greek alphabet? But the underlying problem is, again, this is a coronavirus. Coronaviruses mutate, and when we look through history at different flus and different strains of coronavirus, they typically get a bit more contagious but less deadly. So, these are some of the things where we're going to continue to see some of that trend. One of the bigger issues as well is when we look into the Asia Pacific, where we've started to crest, which is a positive, but you can see that things still remain sticky when you look at Indonesia, Malaysia, and some of these other ASEAN countries. Some of the bigger problems that we continue to see is vaccinations, which remain very slow, and we've actually started to see some of these, some of the pace slow down, which again is just going to continue to keep some of this fairly sticky. And just consider this is happening in the summer months. So then what does fall look like? What does winter look like? And that's where we start to get some of these friction points, because you can say that the southern U.S. is less vaccinated, which is true, but think about the heat in the south, then you're going to be more indoors. So when you look to the U.S. to the north, are we going to see something similar? Even though we have a higher vaccinated level, as people go indoors, will we see some of these infection rates pick back up? These are things that we're going to continue to look at. And it's not that it's going to cause a big panic, or at least it shouldn't. It's just you're going to adjust some of your spending, some of your travel, just to avoid unwanted exposures. Which in general is wrapping all that up. It just impacts underlying crude demand and product demand. So when we look at crude oil, there was a draw of 450,000 barrels. Still 41.1 million below the 5-year average. But when you look at some of those shifts in terms of where that is, a lot of that still sits in Pad 2, where Pad 3 is now above where we were in those previous periods. Because when you look at just Pad 3, we're now actually 300,000 barrels above the 5-year average as we continue to get these builds in Pad 3, because we have that production coming back, but exports are still remaining very slow. And this is what we were calling for at the end of June as we started to come into July, that we were going to see this slowdown and we were going to average closer to 2.6, 2.8 versus where we were at this 3.6 level, which just wasn't sustainable given spreads in the market. Then we would look at Cushing. Cushing had another draw of 320,000 barrels. We're now 14.2 million below the 5-year average, but we're right in the 15-year average, and we were expecting to start to see this increase a bit, but it's continued to draw. So I'll keep saying it because eventually it'll be right. But these are things where we continue to see some of these drawdowns. But 100,000 barrels came back as some of the work ended in the Gulf of Mexico. That will continue to get, based on what the EIA is saying, up to 11.4, but we have it a bit above that, just shy of 11.5. But again, moving more into that level. So then when we turn to the floating and land storage market, you can look at land storage. So stockpiles, and this is not last week, but the week before, fell by 9.3 million to 601 million barrels around the world. But some of the shifts that we're seeing in general is state-owned China, Sinopec is actually cutting run rates, and they plan on doing that between 5% and 10% this month. And by this month, I mean August into September. And it's really being driven by a lot of the slowdowns that we continue to see within China itself, which is going to leave more within Shandong teapots, within Japan. But when you look at this is a piece of the puzzle when you look at land storage, because while land storage had a drop, and this is something that we were saying the last few weeks, as we had oil going from, oil on the water was increasing based on oil in transit, stockpiles in floating storage increased 13.4 million barrels, with the biggest increase east of Suez. So even though we had those draws on the land storage side, it's going to be replenished based as floating storage goes into land storage, and we get some of this movement back as we've actually shifted up. And when you look at the trend, especially when you look at east and west Suez together, the trend is typically a drawdown into September with builds coming back into October. Instead, we're getting a counter-seasonal build. And that's again, a lot of this crude was purchased ahead of time before we had increases in China on COVID, other places within Asia, which again is going to leave a bit more in storage. And this just puts that into perspective. So when you look at road fuel demand, China, it continues to dip. So far this is going to move closer to 80%. So you're going to see road fuel demand dropping by about 20%. Europe has weakened again. North America, or you should just say Americas, has softened. And when you look at Americas and Europe, this is more, Europe is coming into a seasonal slower period as you come into the end of August. And that's because there's a lot of travel that happens at the front end of August, and then you get a lot of vacation, and then you get some of that pickup. And you can see some of that in terms of what happened last year. When you look at July into August for this European number, you can see that there was a drop, and then there was this big movement back to normal in September, October. We expect to see something very similar because it's more along seasonal norms than anything else, where Americas continues to weaken. Mixture of US and Latin America, but then rest of Asia has gotten a bit better. So as China comes down, rest of Asia is starting to come back up as some of these COVID cases moderate. But the reason why China is going to continue to get a bit worse is because we continue to see restrictions and other types of limitations placed on movements. And this is just looking at China highway passenger traffic, which, this is just looking at it for June. So you can see how things have continued to get worse. And when you consider it against 2019 and 2020, they've never really even gotten back to where they were in 2020, which again is putting some of that pressure on that underlying demand. And this is just looking at the mixture of road congestion. Airport departures have fallen precipitously down to 40%. Subway rides continuing to also come under pressure. So these are some of the underlying problems that when we're looking at in Asia, because remember, we've been saying look, China's been weak, remains weak, hasn't gotten much better on an economic level, GDP level. And now this is just added pressure when we consider underlying demand. And when you look at the plunge, capacity in China sinks amid efforts to control the virus. But when you look at who is normalizing, and specifically when you look at India and Japan, they're getting better, but they're not getting to where they were. And this is where, when we speak about Asia specifically, this is why when we look forward at what is going to come into the U.S. markets, the Atlantic Basin, PAD 5 on the West Coast, a lot of the product and demand that should have been absorbed into Asia just isn't going to be there, and that's going to get displaced into the U.S. markets. I should say U.S. and European markets. And the reason why the European and Latin American markets become important is because when we look at U.S. exports, that's where a lot of these exports go, and that's where we're going to see some of these slowdowns. Again, just showing you just the general trend overall. So then when we look at U.S. crude storage, you can see that we're now back above 2017, and we're having a counter-seasonal increase. So this is where we're getting one of the bigger increases, which again speaks to some of the pressures, because this is where most of our refining capacity is. And if this isn't seeing some of this normalization, that's where we're going to continue to see some of the pressure, especially when we look at underlying crude prices. Cushing, you can see right here, the blue line, the two blue lines, the blue line right there, it's just below the 15-year average, but starting to flatline. I should say continuing to flatline, but still trending lower. So this is the one where, as we get into the end of August, you're going to see that trend and start to shift higher as bills start to creep back in. Then when we look at imports were down 36,000 barrels a day. 1.38 million below the 5-year average, but still at that 6.4, because we've been saying that about 6.4 to about 6.6 million barrels a day of imports is going to be fitting for, especially when you look at the shift from gasoline into distillate. You're going to need that heavier cut, which is going to come from the import markets. And then, as we were saying, PAD 2 had a little bit of a bump, 41,000 barrels a day. PAD 5, 155,000 barrels a day. But PAD 5 remains lumpy, but you can see is still well over the 5-year average by 182,000 barrels a day. But PAD 2 is the one that we think is going to see a bit more of those increases. Now, when we look at the refined product side, so European gasoline arrivals in the U.S. had a rebound to a 3-week high, 7 days through August 5th, speaking to last week. Transatlantic flows were 479,000 barrels a day, which is the highest since the middle of July 15th, which compares to 292,000 barrels a day the previous week. 11 tankers have discharged a total of 3.06 million, with 2 ships arriving on the Gulf Coast. Now, when we look forward, just to give you some of the color for where things are right now, when we look at in general, we can see that European refined fuel exports still remain elevated for where storage is in Europe, but it's still below where we were in July, but again, still higher than you would expect. But when you start shifting between where the different gasoline storage is in the U.S., and we'll talk about this in segment two, Pad 1 still has some of this spread open. There's still some of this arbitrage. It's gotten tighter, but still remains fairly open, which is providing some additional flow, with fuel departures declining to just 705,000 tons aboard 17 tankers in the first 11 days of August, which compares to 32 or 1.21 million tons in July. So in addition, 22 tankers have been booked to load an additional 860,000 tons. So we're still going to see some of this flow. It's just coming to, and it's just seeing a bigger slowdown just given where things sit, because when you look at total exports for last month at 3.06 million tons, you're getting an idea that, look, we're still going to get some imports. It's just not going to match July, but we've already started to see demand slow. So we really don't need to see July levels to see some of that, as we keep talking about those builds, or I should say draws in gasoline really starting to slow. Then when we turn to runs came up to 91.8% with an increase of 50 basis points. It was pretty much a steady increase across the board, with really Pad 3 and Pad 5 seeing the increase, as we were now at August 11th on our way to the essentially the peak. We're going to start to see not so much slowdowns, just because we never got to our normal 97, 98% utilization rate. I should say 96 to 98% utilization rate. So because we never got to the peak, the drop down won't be as aggressive, but we're going to start to see some of those maintenance season, some of those turnarounds come through as we get into the end of August and into the beginning of September. So we should stay between this 91.5% to 92% as we go through the remainder, or the next 2 to 3 weeks. Implied demand, when you look at gasoline dipped by 345,000 barrels a day from 9.77 to 9.43. We still think that there's going to be another shift lower, something closer to about 9.1, 9.2. And we'll talk about some of those shifts in general in terms of what the movements are. Distillate had a small bounce of 116,000 barrels a day, something that we thought was going to be a little bit stronger. But again, we'll talk about some of the shifts that we've seen in the near term with diesel and between trucking and rail. So when we look at Jet had the drop that we were talking about. It actually dropped by 367,000 barrels a day, which was bigger than what we were expecting, but still within a comfort range. So now we're still going to get a bounce back up, but it's just going to be the amount that we get. It's just when we look at gasoline, that's where we're starting to see some of those pressures. Especially when you look at some of the movements of Asian refiners and Asian product coming into the U.S. markets and European markets, which again will slow some of our exports in general. So then when we look at floating storage in the U.S., we're back within the bottom of the cloud. And again, as we keep saying, it's going to be fairly stable, at the lower end. And when we don't see it really exploding higher or lower, it's just going to continue to go sideways, just given the slowdown. With such low imports, we don't have the same type of timing delays, so we don't have the same amount just sitting on shore. It's a bit faster coming in, which is keeping this nice and depressed. Even though crude imports into Pad 3, you can see came down, we're still within the bottom of the cloud, and this is something that we think is going to spike back up. Again, not spike up in the sense where we're going to go back to this 5-year average, but just stay within the chevron pattern, if you will, as we go sideways. Where when we look at Pad 2, it bounced, but not back to the 5-year average. This is where we think there's going to be that steadier move back to that 5-year average over the coming week. And then when we look at refinery utilization rate over the last 29 years, you can see that we're just below where we normally are for this period of time. So Again, when you look through the historics, very similar, but when you look at the last 5 years, still depressed. But in general, just gives you an idea that there's going to be a lot of pressure on refiners because there's really no need to see a big increase over the next few weeks. And then when you look forward, you can see that there's typically kind of that slowdown as you go into the shoulder season, which typically reaches the lowest level as we get into the end of September, beginning of October, and then you start to see a ramp up for heating oil and that diesel side, which we're going to talk about as we get closer. But now in the next segment, we're going to go deeper into refined products and what's happening within the U.S. in general.